Hello class, this video is just to give you a brief review what's covered in chapter 1 and chapter 4, and you can find the class website of 2018 in the fall semester I taught last time, and it's basically the same kind of structure, so you can use this website as a reference. You can go to my website jufinance.com. You can find the link to this class. Okay, for chapter 1, it's an overview of the financial management or financial market. So in this website, I listed several concepts. Let's just have a quick review. Primary market versus secondary market. We know primary market is when investors buy directly from the company. That's called primary market. Example is just IPO. The transaction happened this way between corporations and the investors, usually big investors like institutions or big private investors, and that's called primary market. Secondary market is once the security like stock was sold to the public and it will be traded among investors, and it's called secondary market. So that's the difference between primary market and the secondary market. Okay, money market securities versus bond and stock. We know money market securities are usually short-term, very liquid, low risk, and low return. Examples is 3 months treasury bill, or 6 months treasury bill, or 1 month treasury bill, where you can just buy the CDs issued by the banks. That's examples of money market securities. Stocks. We know what stock is. Usually investors buy stocks for long-term investment goals, and bond is another way investors can buy to invest for long terms. The difference between stock and bond, and we know both are the ways the company can raise capital from. One is from the stock market, one is from the bond market. Stock is just giving the ownerships to the investors, but bond is the companies is borrowing money from investors in the bond market. That's the difference. Stock usually is more risky than bond. However, the returns will be relatively higher for stock investors than bond investors. Because of the nature of these securities, you can find more information for bond and stock in the later chapters. The goal of the corporation and the standard answer for this one is always maximize shareholder values, even though there are other goals of corporations, but the main one should be maximize shareholder values. The next one is IPO versus SEO versus going private. IPO happens in the primary market. SEO also happened in the primary market. IPO is when the company from a private company and to become a public company, and that process is called IPO, initial public offering. So IPO is just like the shareholders can buy directly from the company at the IPO. After the IPO, and the private company before the IPO should be private. After the IPO should be the public. So SEO is when the public company want to raise more capital from the stock market, and they can sell more shares to the public. It's called SEO, seasoned equity offering. Also, some public companies could choose to become a private firm again, it's called going private. So the regulations for private firms and public firms are a lot different. It's more strict for public companies to avoid this kind of releasing more information to the public. The company can choose to go private. There's an example called Dell. Dell went public and went private. So it's going private, IPO and SEO. we know what's the difference. We heard a lot about NYSE and NASDAQ. So I don't need to explain these two terms here. The agency problems, and agency problem is persistent, and it's a big problem, and there's no way to completely eliminate this agency problem. Agency problem is caused because of the separation of the ownership and the control. The ownership is by shareholders, but the control of the firm is by the CEOs and other executive managers. So because shareholders or the owners of the firm are not controlling of the firm, so the CEOs are hired by the owners to run the company. So there's always agency problems, just because of the separation of the ownership and the ownership and management and control. So there are ways to reduce the agency problems, to reduce the agency cost, like giving the options to the management so they can focus on maximize shareholder values. So increase shareholder price, stock price. So when they exercise their options, they can get more money back. So also the reputations of the management market, CEO market, could work as a mechanism to sort of reduce the agency problem, but it couldn't be eliminated completely because of the separations of the ownership and the management. So that's agency problems. Investment bank and commercial bank. Investment bank, we know the biggest investment bank in US is Goldman Sachs, and there are other big names, and we always heard their names from the news. Morgan Stanley and Citi has investment bank section also. Commercial banks. So the banks, like customers went to deposit the money to get the loans from, those are the commercial banks. Investment banks usually work with the big institutions, like the company want to go IPO and want to do SEO, want to issue a bond, and they all work with the investment banks. But for people, regular, normal, ordinary people, we are mostly dealing with the commercial banks for like business, like commercial banks usually do. So the scopes of the works done by investment banks are dramatically different to the commercial banks. Intrinsic value versus market value. The market value is just the market worth of the firm. Usually it's calculated by looking at the stock price of the company multiplied by how many shares outstanding, and that gives you the market cap of the firm. But sometimes it tells like how much is the market value of the firm, but however it might not truly shows the intrinsic value or the true value of the firm. The intrinsic value or the true value of the firm should be calculated by like how much money could be earned, could be generated by the firm, and then we should consider how much profit the company can make to calculate the intrinsic value. Market value is just totally the demand and supply of the investors. So in the stock market, to determine the market value. So there's a big difference. So yeah, the market value, you should also consider the debt, the amount of debt has been raised also. For the intrinsic value, to calculate the intrinsic value, you can look at the graph here. So you see, we can discount the free cash flow generated year by year in the future at the rate of WACC WACC, weighted average cost of capital, to calculate the intrinsic value. Yeah, free cash flow. If you go to my website, and you will see the free cash flow's definition. You go to the website, you can find the free cash flow here, free cash flow calculator. So you will see the equations to calculate the free cash flow. So we know how to, we know what's earning. So free cash flow, you see the equation equals to see, there are several ways to calculate the free cash flow. So it's using EBIT. You see, using EBIT and subtract the tax and plus depreciation, and then subtract spendings for long-term asset, and also subtract the net working capital changes, and that give us the free cash flow. So this is a calculator. So you see, free cash flow considers both like how much money has been earned in that year, which is EBIT, right? And also consider like money spent for long-term investment, and also money spent for the short-term investment, and that's free cash flow. But earning, we know earning basically is just net income. If you go to the financial statement and you see the income statement, and you see this is net income is just earning. So you see net income is simply just taking out all the expenses from the revenue, and that give you the net income. But it's not considering how much the company spent for long-term or short-term and long-term and short-term assets. And so it's not considering that part. So we should use free cash flow. We should consider free cash flow. It tells like how much cash the company has, the cash flows the company has. So it's more relevant to our task here, just to figure out the intrinsic value. There is a big difference here. Okay. In this website, so how much is, you can go to you see the website here. So I showed like how much is the free cash flow for Amazon, and also has the equation, how much is the weighted average cost of capital. It shows the details how to do that, and then so based on the information, so it gives the estimations for the firm value, intrinsic value. So you can take a look. So this is chapter 1. So free cash flow is a lot more useful, and it provides more information to the investors. So a company could have high earnings, high net income, but has a low free cash flow, and that's not good. So we want something to have lots of cash put aside. But it's hard to manipulate free cash flow, but we know it's easy to manipulate the earnings. And this is a chapter 1. In the next video, and I will explain chapter 4.